Half a day, everyone. We are Team C, and today we'll be presenting on General Electric accounting fraud. My name is Bernadine.
I'm Christine.
I'm Sophia.
So, first, we have the case background. General Electric was sued by the SEC for improper accounting procedures that was not in compliance with GAAP. The senior accountants, under the guidance of CEO Jeffrey Skilling, produced false statements that increased the profit and earnings of the company in order to deceive shareholders and gain bigger bonuses for the executives.
General Electric's key players were Jeffrey Skilling, which is the former CEO of the company at the time of the fraud, and the party responsible for the accounting fraud, Sharon Watkins, the former vice president and Congress-anointed whistleblower, who was the person who reported Jeffrey Skilling's accounting fraud to Kenneth Lay, who was the founder of General Electric and the person who enabled Jeffrey Skilling to commit the fraud.
Next, we have the ethical dilemma. One major ethical dilemma that General Electric faced was the complete disregard for upholding the GAAP standards. GE executives approved the reporting of improper recording of some of the transactions within the company. Two GAAP standards that were not approved within GE were the revenue recognition principle and the intentional material misstatements. Under the revenue recognition principle, GE intentionally recorded sales that were incomplete in order to increase revenue. This action caused revenue of GE to increase by $370 million. Under the material misstatements, GE failed to report the $200 million pre-tax earnings in order to meet projected expectations. General Electric also failed to report proper earnings to the IRS, which impacted the GE's investors and shareholders. As can be seen in this case, General Electric CEO Jeffrey Skilling was an individual who exemplifies the fraud diamond. He was pressured into meeting projections, which is why he approved the improper accounting recording. He rationalized the situation by stating that they needed this in order to meet the expectations. There was an opportunity to do so because Skilling was the CEO. And lastly, Skilling was capable of doing the fraudulent act because he controlled and approved everything.
So moving to the consumer and deduction, the U.S. Securities and Exchange Commission discovered violations of accounting standards during a risk investigation of General Electric's accounting practice. So the Securities and Exchange Commission conducted a more thorough investigation of General Electric. For example, an investigation plan was developed to test whether the problem actually exists. The investigation found four accounting violations that violate General Electric. The first accounting violation was the company's attempt to avoid adverse discovered accounting standards are not properly applied to commercial paper financial plans. Starting in January 2003, the estimated pre-tax expenses are approximately $200 million. The second accounting violation is an amendment in 2003. During certain period when the company's interest rates fell, financial accounting standards were abused, according to reports. The third accounting violation has not yet achieved year-end sales of our locomotive. Between 2002 and 2003, revenue increased by more than $370 million. The fourth accounting violation is that the company made incorrect adjustments to the accounting methods used in the sales of commercial aircraft engine parts, which increased General Electric's 2002 net income by $585 million. Next. So for the result of the case, the Securities and Exchange Commission filed several fraud and other charges against the General Electric company. They accusing the company with false and misleading results in its financial statement for misleading investors. Generally, accounting decisions of a company need to be motivated by the right aspirations rather than achieving specific business goals. However, the company abused accounting standards to better reflect its financial performance. The company used incorrect accounting methods to increase its income and avoid reporting negative financial performance. The company has agreed to pay a $50 million fine to resolve the allegations. However, in the end, the company did not accept or deny the allegations. They just agreed and to accept the penalty.
On to our recommendations. Our first recommendation is to promote transparency through proper segregation of duties, limiting incentives by avoiding a system that rewards biased disclosures, and encourage a safe environment to discuss ethical issues. One advantage of promoting transparency includes the establishment of trust and accountability among employees. However, the information that is shared may be distorted and the company's privacy may be at risk. Our second recommendation is to perform assessment of financial statements. With the help of an independent auditor, the company's financial statements will be reviewed annually to assess the quality and correctness of these statements. The main advantage of assessing the financial statements includes the early detection of accounting fraud. Our third recommendation is to establish standard operating procedures for similar situations. This would be advantageous as established protocols for situations such as this would allow for an efficient and effective resolve of issues.
That concludes our presentation. Thank you for listening, and we hope you have a nice day.